Welcome back. We mentioned a cautious start to the new trading week, some of the uncertainty in China. One trend so far that we have seen in North American activity is some profit taking in big tech, which was obviously one of the big winners in the first half of the year. That benefited the S&P 500 compared to the TSX. Now, coming into this trading day, the TSX had lost some ground this month, but less so than the U.S. markets, in part because of some outperformance, for example, for energy coming into today's oil weakness. Some pundits have argued the current environment could be better suited for Canadian stocks versus U.S. names. Let's talk a little bit more about what we're hearing and seeing with the money flows here in Canada. Rohit Mehta is President CEO of ETF player Horizon, and he joins us here in studio. Nice to see you.
Great to see you again, John.
So I guess when you look at where the money is flowing within your ETF landscape, what have been some of the highlights of late?
Yeah, absolutely. We're seeing a couple of key trends here. One is around shorter term, so cash, high interest, T-bill products where we've seen significant amount of flows. That's for a couple of reasons, as investors are seeing better opportunities with rising rates in these shorter term products, as well with the opportunity for investors to take money and put it on the sidelines, while as we're seeing some uncertainty that they're waiting, as a great holding place to deploy it. The other area is around income in general, as we have aging populations, a number of key drivers there. So into the covered call space, we're seeing a number of significant flows as an industry, as well as for Horizons.
So dealing with uncertainty is a bit of a theme, you'd say, with some of the money that's been coming into ETFs.
For sure.
Yeah.
It's definitely been a part of a theme. The year to date has been pretty strong. I think investors were pretty rattled in 2022. Yeah. And so 2023 has been off to a great start. But all the data that's coming in these days, they're trying to digest it and realizing that you can't just keep money on the sidelines, not earning anything anymore as we have inflation. So money that's, cash that's not earning, complacent cash might have been a thing a few years ago. Now with higher interest rates and inflation, you have to make sure that if you have cash, it's working for you.
Well, we talk a lot about that with some of our market guests, moving in, out of the market, and some of the pros and cons of that. Within even your ETF portfolio, do people shift focus, kind of move from one fund to another on a relatively constant basis, depending on what's happening?
You see a bit of both. There's definitely going to be those that are going to use, our, extensive lineup. We have 113 ETFs, 27 billion in assets under management. So there's going to be those that are going to want to use some of those strategies as far as timing the markets, and others that are using them as long-term building blocks. So we definitely see both.
Okay, but the overall amount of money that has come into ETFs in Canada this year would not suggest that investors are retreating. Is that fair from what you're seeing?
Correct. I would say the trend is that investors are continuing to move into ETFs. We've seen $22 billion in Canada in inflows into ETFs. And that is, contrasted with $13 billion of outflows from mutual funds.
Is fees at the end of the day at the front?
You actually hit the nail on the head. There was a great report out of the Financial Times last week looking at the U.S. flows for 2022, and they showed that the lowest cost 20% of investments, ETF or mutual fund, just investments in general, garnered $400 billion of new flows, and the 80%, that remaining higher fee category, whether it's ETF or mutual funds, saw $700 billion of redemptions in 2022. So fees are definitely an important part of the story.
The counter that you hear to that often is, well, hold on, it's getting kind of complicated out there. You need to be more actively looking at your portfolio. Active managers can help you there. I know that the ETF world has brought a lot of actively managed ETFs as well. But what's your take on the response, I suppose, from the mutual fund industry on the fact that, well, you get what you pay for with fees?
Absolutely. It's always a balance of measuring out value received versus price paid. And it's always looking at what that means. So in terms of some of the market exposures. For example, we launched our HBNK ETF, so that's equal weight banks. We brought the fees down on that, so that is at 9 basis points. It's less than half the cost of our nearest of any competitor. And in addition to that, for investors, we said for the next 12 months, so till July 31st of 2024, it's actually free. Zero management fees, zero MER.
So the marketing push resonating with audiences and investors right now. Bloomberg Intelligence had an interesting report with ETF providers in the U.S. that when these largest ETFs hit a certain size and scale, they end up getting a the lion's share of the new money that comes in. Is that common? Like with your biggest ETFs, they still tend to be the ones that are getting larger and larger within the whole ecosystem of ETFs you have, even though you have quite a few.
Right. So there is an element of size begets size, momentum begets momentum, and then it's around innovation. So where you're coming out with something that isn't that differentiated, the larger ones generally, if you're not as competitive, will get the lion's share. And so that's where we really have aimed to continue to innovate, and has really helped us to be a leader in generating and gaining assets this year and over the last a decade plus.
Okay, thanks.